$5 million is a lot of money. Having that in cash, for the most part, most families are going to be okay. But it's all relative. If you only have $5 million cash and you're worth $1 billion, that's probably uneasy. But if you have $5 million cash and you're worth $20 million, then you're in good shape. I look at wealth differently than others. Wealth to me is opportunity, and it will always be. As you get older, you realize having money is nice, but with money, creating experiences and memories is what is the end goal. You can't take your materialistic things with you. When you have wealth, you can do many things with it, and that's obviously on you. You could buy things that you like, you can go on experiences, travel, you can do good for others. For me specifically, learning this from my family, it's always about experiences and trying to do good for others.
Welcome back to the Rasha Family Podcast. We're here with another special episode on our Family Office series. I have my co-host, Shuvam Bhaumik, and he's the head of Family Office, Capital Markets, Strategic Wealth Architect of High Net Worth families. Going into a little bit about Shuvam is the head of Family Office and leading that advisory firm with a singular mission to help high net worth individuals and families turn complexity into clarity and capital into generational wealth. Most of Shuvam's clients and the visionaries that he works with, which you could also call family, are business owners, executives, entrepreneurs, people who want more than just off-the-shelf strategies. They want access, precision, results, and them being able to deliver all three of those is quite powerful in terms of helping people, with their vision. So quickly, we talked a little bit about geopolitics and kind of what's happening. So I think this is a great chance for us to talk about that and how is that impacting people's lives, especially in the field that you play around the world. So actually, if we can just start off with, there was just a bit of news yesterday. There's a ceasefire with the US and Iran. What does that mean? This thing with the Strait of Hormuz, if you can just explain a little bit about what does that mean and what does this mean for investing and wealth? And let's talk about it.
Sure. I'll answer that from a perspective on my side, from an investing perspective. From a political perspective, I don't know. I'm not that well versed as I should be in the politics world. But yeah, the ceasefire, which was announced, I think, a day or two ago, the hopes has created some positive news for the markets. Market reacted really well. Commodities acted well. Oil, took a little bit of a dip because of that, which was expected. So I think investors, institutions are hopeful that, this war can come to a resolution sooner rather than later. And obviously the ceasefire is the start of that. You asked on the Strait of Hormuz. I mean, that's always the underpinning and the control that Iran has on trade. And I don't know exactly what's happening there on a day-to-day basis. Iran has said they're going to close it, based on if Israel keeps attacking Lebanon. And there's a lot of news going back and forth on that. I know, obviously, most countries need to have that channel open for trade. So hopefully there comes a resolution and there. But as far as the ceasefire is concerned, it's the start of a hopeful process that this war comes to an end.
Okay. And so how has this war impacted any of, for example, potentially is any clients it's impacted? What questions are people, within, the people who work with you have been asking about investments? What does this mean in the big scheme of things? Because we're seeing a lot of stuff on the news, the gas prices, oil prices, there's so many things that are happening.
Marketing is all about storytelling. Dad, when we first started this business, what did you say to me?
I said, yes, we do a podcast.
Why?
Because I want to tell our story.
Why?
Because I know the story builds a legacy.
Builds a legacy. And that is exactly what we do here at ETS Rubasha Media. We market your story on social media so you could build a legacy for those who come after you, to build your business and your personal brand.
Yeah, follow us on our platform. Go on our website, etsrubashamedia.com.
This is about legacy, and it is about showing up on social media every single day, because if you don't show up, your competition will.
Good question. Definitely a lot of our business owners are feeling the effects of it, where if they're landscape companies, they have trucking, all of that, if they have employees that are commuting back and forth to work, gas prices are definitely affecting a lot of individuals as well as companies. I think the overall, though, it's not going to be a deep effect on portfolios. In times like this, I don't like to react in a sudden way that's going to change portfolios in any way and things like that. Again, this is why we have the investment policy statement, and we go back to that to make sure that we are on track. We can't control week to week, month to month, or even year to year events that are always going to happen. Next week there might be something else that we haven't predicted. I think I always try to be the calming voice with our families and clients and say, hey, we're on track, we're okay. But there are real world effects, as I mentioned, when it comes to expenses going up for a company. So in some ways, I do keep that in the back of my mind when we do look to allocate investments. Do we keep more cash on hand than we originally forecasted? So there are little things like that we're looking at, but overall, not many changes.
And anything with the fuel prices that obviously this war had an impact on, like did that impact anything in regarding to business on your end with clients and their businesses?
Yeah, as I was mentioning, yes, the depending on the type of business that my families are involved in, some are in the blue collar workforce where they have, HVAC companies, plumbing companies, landscaping companies where they have trucks and manpower and things like that, and utilizing heavy machinery. There's definitely an effect. One client was mentioning to me that his forecasted expenses of fuel expense is probably going to go up by $150,000 to $200,000 this year, which is a meaningful impact that we have to make sure that we're having that in the family office structure from a cash perspective. Those are the effects that are not just our families, everyday people are getting affected by. Me when I drive, and I live here in Boston, Massachusetts. Gas was considerably under $3 a gallon. Now it's near $4 a gallon. So that's definitely an effect on the wallet for most of our families.
Wow. Okay. And when it comes to like families and this world space,
Mm-hmm.
is it more around building the business that they've all created? Like all these majority of the families that you work with, is it around all businesses that they're actively in, or does it just mean more of a investor higher at the top, angel investing, or these are businesses that they're actively involved in and growing and going through that at the moment?
Yeah, it's a combination of both. Majority of my families have businesses that I am deeply involved in, acting as a CIO for their family office, but obviously a lot of their liquidity net worth is tied up in their business that we have to factor into allocations of portfolios. So it's a combination of both. I do work with a lot of founders and entrepreneurs that have had liquidity events or are in the process of having liquidity events that we can allocate more like a traditional portfolio. But I would say that's probably 25 to 35% of our families. Majority of our families are existing business owners that we have to factor in their family office structure.
So, like, what's the biggest pain points they go through? And have you seen, a little bit with maybe the geopolitics situation at the moment, has any of that been impacted?
Yeah, I mean, yes, I think the everyday conversations that we have is how do we manage cash? That's the majority of our conversations today. Like I said, fuel expenses, other expenses, the unknowns of what's going to happen. Obviously, with the volatility in the stock market, leads to some uneasy feelings in their overall portfolio. So they want to up their cash position a little bit higher just to feel a little bit safer. So those are everyday conversations that we're having with our families. It's my job to make sure that they are allocated properly on their investment side, and then obviously managing their cash position to make sure that what they're forecasting in the next 3, 6, 9, 12 months, they're going to be able to sleep at night. Business for them is also unpredictable, right? It's not a steady cash flow as it was, maybe 2, 3, 4, 5 years ago. So there's a lot of moving factors with what's happening in the macro geopolitical scene, but I always try to be the calming voice saying, hey, we're okay, from a cash position as well as from an investment position.
So that's interesting. So you said it's majority of the conversations you have are around cash.
Mm-hmm.
What's the issue? They have too much cash and I don't know what to do with the cash. Where does the issue there lie?
It's the opposite. They think they have too little cash on hand because of expenses going higher. No one forecasted, that fuel prices are going to increase someone's balance sheet by $250,000. You can't forecast something like that. So when it happens, it gives an uneasy feeling. It's my job to make sure that we're able to meet those forecasted numbers from a cash perspective. At the end of the day, these families are okay. They're not going to struggle. What I feel for are the families that are on that brink when fuel goes up and they're all of a sudden they have this unforeseen expense, and how do they plan for that? Those are the families that I really enjoy conversing with, because it's almost like playing chess, right? How do we manage this chess game? I think majority of our families, they're okay. It's just a level of comfort that I need to give to them from a voice perspective that we're going to manage this okay. The reality is this war is not going to last forever. I hope. I don't know that, right? I think gas prices are going to normalize in the next 2 to 3 months. Obviously, with the summer coming up here in the Northeast and on the East Coast, gas prices rise because more people are driving and more people are outdoors. But that's normal everyday occurrence. I think this has created a little bit of a uneasy feeling that we're going to get through in the next, couple of months.
Mm-hmm. Wow, that's very interesting. So, how much money do you think you would need for like when something like this happens for you, this not even to worry you? How much money do you think you would need in whether is that in assets, is that in cash in the bank? How much money do you think you would need when a scenario like this out of the blue happens that you're fine?
Well, the way I'll answer that is not from an actual dollar perspective. I'll answer in a percentage perspective. I think I usually like to keep 10% of one's portfolio in cash, just because of things like this can happen, but also take advantage of opportunities that may come up. When situations like this happens, I like to increase that position probably to 12 to 15% total. And how do we do that? We kind of lay off future investments, or we delay future investments. And anytime if we do have cash flow coming in from investments, instead of reinvesting, we now keep it in cash. So there's many different things that we can do, but it's hard to answer that from a dollar perspective because every family's needs are different, right? If you have a multi-billion-dollar business, your cash needs are going to be different than someone who has a $10 million business. So it's hard to answer that from a cash perspective. But I think the percentages kind of will be universal in most cases.
And I guess on the dollar amount, I think that's very, very interesting. If you were to say the normal family or even the entrepreneur, right? Someone who's had a vision, who's had a dream, and who's built it. Is there a dollar amount you could say for that? $5 million, $10 million that someone has overall that in a situation like what's happened, that they can continue to stay calm because it's like, okay, I'm good. Because for me, it's about painting that picture of how much, if it is a cash, how much do I need to have for this not to worry me?
Yeah, so if you're saying a family is worth $5-10 million, is that what you're saying?
No, I'm saying, could that amount be five? So let's say if we don't know how much the family.
Yeah, I think, $5 million is a lot of money. $10 million is a lot of money, right? Having that in cash, for the most part, most families are going to be okay. But it's all relative. If you only have $5 million cash and you're worth $1 billion, that's probably uneasy. But if you have $5 million cash and you're worth $20 million, then you're in good shape. So that's why I kind of answer that by percentage amount, right? So if you're worth $20 million, you probably, to be comfortable, where situations may arise and then you feel okay that you can, meet those demands, probably 10-15% of your net worth you should have in cash. So that's why, as I was saying, it's hard to give a physical dollar number, because that dollar is going to change from family to family, net worth to net worth. So to someone who's worth $5 million, having $1 million in cash, you're okay. $10 million, having $1 million in cash, you're probably okay. But if you're worth $100 million, having $1 million in cash, you're probably not feeling great in situations like this. So that's why we tried to up the cash position, 12 to 15%, rather than having it at that standard 10%. And that's probably just being extra cautious. The reality is, their business is cash flowing, they have cash flowing investment that they can meet all of their demands. It's just to be prudent in case this prolongs more than what we all think, right? Our administration is thinking this is going to be a 6-week process. Well, I don't know what week we are in during this 6-week process, but it doesn't look like we're going to end this anytime soon. So if this goes on for another month and a half, 2 months, we want to make sure that we're positioned properly, that we can withstand any rises in not just fuel, food costs. I mean, everyday costs are going higher because of what's happening here.
So, I'd love to know, when it comes to building and growing for these families, how do you stay conservative in terms of saving cash? But then you have people who, they want to keep investing, whether that's even investing in their own business. If we have this business, maybe we're investing more in the business, but then we also got to save then there's also other investments. What's the balance that one must keep in all three of those things in terms of saving cash, investing? Because if I invest in my business, this is I'm going to be able to bring more money.
Sure.
Or then investing in other projects. But then you don't want to be too, all in one side gone, because you might not have. Yeah. So what's the balance and role should be in that?
Yeah, I think in this situation, depending on your cash flow, whatever your cash flow is, 10 to 15 or 12 to 15% of that should be set aside and put into cash. Again, it goes right back to the percentages, right? It's not, I don't want to say it's not complicated, but it's really not complicated, right? I'm a math guy. So if you just do numbers, it's very easy. If you're cash flowing, let's just say $100,000 a month, you're taking, 12 to 15,000 of that and allocating it into a cash that you normally wouldn't be doing. You're just setting that aside. And then when this all passes, you could reinvest it. The remainder of your cash flow that's coming in, you can reinvest it accordingly. Now, that's the business side. On the normal investment portfolio side, I'm cautious. So I'm not heavily allocating to investments today. I'm definitely doing due diligence on investments today, in the normal portfolios that we focus on: private credit, some real estate, some alternative assets and investments and things like that. Definitely doing due diligence. But as far as physical allocation today, it's more cautious than I would say in a normal period.
And have you seen any, with the investments that you've done in the past or helped do with your clients, have you seen how in the past a geopolitical situation, even we had COVID, has infected an investment directly, whether it was before the due diligence or during the investment or after?
Sure.
Has that ever happened before?
Yeah, I mean, yes, in the last 5-7 years, it's happened multiple times. COVID obviously being the biggest one. That had major effects in every portfolio. Liquid markets, equity markets, both private markets, private equity, interest rates obviously, went to all-time lows during those periods, and then it rose, precipitously shortly after, which caught everyone in the real estate space with their pants down. So there are deep effects. And, when you have situations like COVID specifically, I don't care how good you are, you can't predict that. What happened during COVID was, the best CIOs in the world, the best analysts in the world, the best CEOs in the world were not prepared for it, right? There was a global shutdown. I don't foresee that happening knock on wood, again, hopefully, but it may, with some of the chatter that's been going on with this war of eliminating civilizations and things like that. I mean, not to get political, that could get a little crazy, right? And that could have deep effects in one's portfolio. Hopefully, cooler heads prevail. And when it comes to that, and the ceasefire is probably the start of that. But if there is another major conflict where there is bombs flying over our skies and things like that, yeah, you have to kind of be cautious. And how do you prepare for that? I mean, it's one of those types of things where, and the investment policy statement and all these things that we have prepared for, we try to stay, focused on that. But there's a lot of unknown elements in those types of periods that I just can't forecast.
And so when something does, is there, and you don't have to go into specifics, but is there a particular like potential example or something like that? I just want to put into that mindset of what do you do when that situation happens? COVID happens, you've put in a lot of money into this. No, what do we do now? And then how do we turn that potential crisis into opportunity?
Yeah, so that's where having cash on hand makes sense because you could take advantage of opportunities. But to the existing investments, what do you do? A lot of people are going to panic sell. That's the worst thing to happen. Sometimes the best thing to do, as I said on our previous podcast, is sometimes not to do anything immediately. Let things kind of simmer and see what's going to happen. Now, using the COVID example, we didn't know the reality of how deep this was until 6 months down the line, right? What we were hearing from the media, what we were hearing from our politicians and things like that, we didn't know. And then we started seeing what the ramifications of what was happening and the shutdowns across the world, and that have really affected the markets. Fast forward to today, we don't know what's going to happen with this war. Hopefully, cooler heads prevail. But let's just play worst case scenario, and this keeps getting prolonged, and a war happens, and that whole Middle East and with the U.S. and God forbid they start attacking us here in the U.S. You're going to have deep effects with the markets. You're going to have shutdowns here. You're going to have businesses that are probably going to fail. You're going to have equity markets that are probably going to drop 10, 15%. How do we prepare for that? I could talk about it today and say, yeah, we'll do X, Y, and Z. But until that happens, it's really hard to prepare for that. If you look at the global financial crisis in 2008, everyone was caught with their pants down, right? You had a couple of outlier hedge fund managers that were betting against it, but those are so far, few and far removed from what everyone else is doing. I don't want to be the not follow the herd mentality in situations like this, but my rule of thumb is sometimes let's just see what happens for that immediate reaction, and then we react to that immediate reaction. Because the worst thing to do is overreact. And that's what most people do in deep corrections, not just the equity markets, also in the private equity markets. Now, the one thing about the private equity markets is it's illiquid. So you really can't go and get liquidity like you can with the public markets, right? So sometimes if you're betting with a good manager and your investments are with a good operator, good manager, good general partner, you try to stay the course, right? With the equity markets, obviously it depends on what your investments are. You could probably take advantage of some depressed prices as well.
Wow. Yeah, I really love the notion of not panicking and staying calm and just kind of letting how things play out. I think it is quite a powerful point.
Well, Sujir, it's easy for us to say that today because nothing is happening, right? Like it's like in real life situations, right? When if a tiger is coming and attacking you, everyone always says you have to stay calm, right? Like the bear, right? People say you just stand still when a bear attacks you. Well, I think that's very hard to do when a bear is attacking you. It's the same thing with the investment side. I mean, it's hard to stay calm. investment policy statement is very important in situations like that. And you go through it, and I try to be the calming voice for our families and say, hey, I know it's not great. And the biggest piece of advice I give to our families is turn the TV off, because anytime you turn it on in crisis mode, you're not hearing positive stuff, which is going to lead to more anxiety, which leads to more probably bad decisions when it comes to portfolio. So I always say to them, turn the TV off and try to go about your day as best as you can, rather than trying to see what your portfolio is doing on a day-to-day basis.
And you talked a little bit about real estate earlier. When a real estate deal comes to you, and I know you have your investment policy statement, what do you look for in a real estate deal that you see potential in helping your clients see a return on investment?
Yeah, I mean, the first thing is you look at the operator who's operating the deal. You look at their track record as best as you can. You do your due diligence as best as you can. We don't always get it right. Sometimes you invest with, partners that have the track record and, have the due diligence, and they check all the boxes, and turns out the investment could go bad. So that's the main thing, is who the operator is and all of that. The second thing, depending on the type of real estate that you're buying, if it's existing assets or if it's development, you look at certain metrics, placement cost, if it's an existing asset, if it's a new development investment, you look at comps, and all those other factors associated with it. We don't do a lot of new development investing. Those are few and far apart. We do mostly existing real estate investment in existing assets. So those are the two factors, the operator and then replacement costs. You look at the traditional real estate metrics, the comps, and all the rental, the net operating agreement, and all of those types of things as well, the demographic, the location. I think those are, in normal due diligence of real estate, but the biggest two factors are the operator and replacement cost.
You talked a little about existing assets. Why existing assets when it comes to real estate?
Yeah, I mean, one, the risk inherently is a little bit less than a new development, because hopefully it's a cash flowing asset, even if it's a value add, meaning that you have to go in and do some renovations and things like that. You could kind of see the light at the end of the tunnel when it comes to rental projections. I'm talking about multifamily specifically here. You could see rental projections and all of that. So you kind of lower your risk. There's still element of risk there, but you kind of lower it, as opposed to a new development. You have a lot of factors. Biggest one is time for the asset to get built. The delays can be, permitting delays, architectural delays, engineering delays. There's a lot of that things go in the early stages of a development before you put shovel into ground. Then when shovel goes into ground, you have to build a structure. There could be delays on the building, fly costs, all of those. There's a lot of factors that go into a new build. And that's why we shy away from it. I live here in the Northeast in Massachusetts, Boston area. There's not many new developments happening. Why? Because land is scarce, right? A lot of the new developments that happen here, they're tearing down an existing structure and building upon that land. When you go down south in the U.S., the Sun Belt areas, the Texas, the Tennessees, the Carolinas, the Floridas, land is a little bit more abundant. You can build more land. Land cost is a little bit cheaper. You can build. We don't do those types of things typically, but that's typically where you'll see a lot of newer construction. But that's the main reason why I like existing assets over new developments.
Which makes a lot of sense. So when it comes to tax, I think that's a big issue that a lot of people go through. How does that work in terms of how can I minimize by paying less tax? Do I have to be a business owner? Again, you're dealing with a lot of families. How does that work in terms of helping us minimize tax, and how do we do that?
Yeah, I mean, a lot of what we do is tax strategy work with our families. There's many different things that you can do to lower your effective tax rate. Real estate investing is one. You have depreciation. You can, through the IRS, there's a I don't know the code, but you could become a real estate professional where you can write off active participation in a real estate, even if you're a passive investor. So there's, you have to, depending on how you structure it, there's that real estate designation that you can do for tax efficiency. There's other investments, oil and gas and all of those types of things. But I think before you get to the investment part, you have to try to understand what you're looking to achieve, because you could create different structures within your family office as well. Trusts, where the trusts are domiciled, who's the beneficiary of the trust, right? So you could lower your effective tax bracket. It's hard to, in this discussion, go over each individual one, but every family will have their unique needs when it comes to that. To relate it to our conversation of like geopolitics and stuff, taxes today are something to look at with the tariffs that are being imposed. So goods and services, costs have risen. If you look at price of cars here in the US, they have gone up because of tariffs that have been implemented to set countries where cars are coming from in Europe and Asia and things like that. So for families, what does that mean? It doesn't have a effect on their effective tax rate, but there is an effective effect on their bottom line when they're purchasing goods. So how do you purchase those goods? If you purchase it through your trust, if you purchase it through LLCs, or let's just use an example, if you're purchasing an automobile, depending on the weight of the automobile, you can have a tax write-off. Depending on if you're using that automobile for your business, you can have a tax benefit, right? So there's many different ways that you can get tax mitigation. Those are the things that we work with our families on a pretty consistent basis.
So at the moment, with again the news with a little bit of a ceasefire happening, what does 2026 look like? Where are you kind of keeping your eye out on? And what does that look like? Again, with you and the passion you have and the advice you give around the investor policy statement.
Yeah.
Yeah, what do you see 2026 look like? Is it going into real estate? Is it, again, private credit? What do you see, and what are you is it businesses? Where's Shuvam's mind as a CIO in 2026 with everything that's happening around the world?
Yeah, so I'll answer that in two parts. On the investment side, I love private credit. Private credit has been getting a lot of media attention. On the negative side, I think there are niche spots within private credit that is very good. So I like that space. Real estate, yes. The short answer is, I think real estate's always going to be a mainstay in one's portfolio in their alternative/private equity bucket. What within real estate do I like? Existing multifamily in certain markets, I think, are going to be very good. I like medical office as well within existing markets, Sunbelt, Northeast. I think those spaces are going to do really well that you can't do telemedicine with, right? So I'm talking about your dental offices, your optometry businesses, things like that, right? So I like the medical office space. Industrial, I think, is also going to be very interesting. And what I mean by industrial, I'm talking about light bay industrial, so sub 250,000 square feet industrial places. So last mile type of delivery. Amazon is everywhere, but they need help on getting you those packages, that last mile, as we call it, right? There's a lot of distribution centers being built across the country, 1,000,000+ square feet Amazon centers, but they still need help getting you those packages. So these small distribution centers, I think, are going to be pretty interesting. So that's in the industrial space. And then with the world of AI today, you have data centers that are very prevalent. That's just not here in the US, that's across the globe. I think on a side note with data centers, you're going to start seeing electricity costs really going higher in those municipalities where these data centers are being built, just because the amount of power AI uses on the computing power. So there's a pro and con to that. But from a data center real estate play, I like that as well. The second part to your question of what does 2026 look like, it's a lot of the same. We've been getting a lot of attention from prospective families on strategy work. That's really 60 to 70% of what we do, strategy work. Family have a significant net worth, they had a liquidity event, they want to allocate their dollars. They're always worried about the investment side. But the investment side wouldn't make sense unless you have the right tax structure in place, the right estate planning structure in place, the right protection structure in place. If you don't have all of that set up, the investments don't matter, because you can make a lot of money in the investments, but if you're not tax efficient, you're going to be paying a lot of money to the government. So, I think a lot of the stuff that we do firsthand is the strategy, and then that forays into the investments.
So the strategy first, and knowing, kind of like you said, a little bit of chess, and then now going into, okay, how do we, put it into action?
Yeah, allocations for us are easy. That's not hard. I mean, I call that table stakes today when it comes to allocating one's portfolio. There's many different options today, many good managers out there today that you can allocate to. But, every family has a unique need when it comes to strategy and what they're looking to achieve. And, it's nice to make a lot of money, but if you're going to pay 50% of that to the government, that's a pretty tough pill to swallow. So how do we structure you properly where it becomes tax efficient? It's the running joke with the Powerball here in the US every year, when there's always this big jackpot that everybody wins. And my comment always is, congrats to the IRS, because they're the biggest winners in all these jackpots. $1 billion jackpot and the payout is 300 to 400 million. Don't get me wrong, I'll take that any day. But 600-700 million of that is being wiped out to taxes. So that's why tax efficiency matters.
Straight to taxes. That's a very interesting one. So look, as we wrap it off, and what we're going to be doing is bringing on other leaders on the show with us. As we continue to build out our series and have these conversations, we'll just play a quick game in terms of, I'll give you a word, and then whatever comes to your mind, you say it. Okay.
Sure.
Politics.
I mean, there's more than a word for politics, but what comes to mind: uneasiness, divisiveness. I'm not a political guy. We've talked about this offline. As you can see here, there's a lot of decisiveness with politics today, and it's terrible to see. And that's why I stay away from it. Because it can ruin relationships if you vote one way or the other. And I think people should respect people's opinions. You have the right to vote for whoever you want to. But I think sometimes it becomes, everything at dinner tables, and that's what I don't like about politics.
You use a lot of those words, like the undecisiveness and things, but why? Like, shouldn't it be a kind of straightforward, like, we have a mission and a vision as a nation, for example, we're going this way. Why does it have to become so complicated?
I don't think we have enough time on this podcast to talk about that. But the short answer is, this is not just from this current administration here in the US specifically. This is, from way back.
Yeah.
It shouldn't be that way, right? It should be for the greater good of the country and the greater good of the man and woman standing and sitting next to me, right? I mean, we're all trying to be in this together. That should be the greater goal, but it hasn't been that way. And there's many reasons for that. There's a huge discrepancy of economics here in the US. Affordability when it comes to housing, affordability when it comes to just everyday life. There's the haves and the have-nots. You have, the Forbes 100 just printing money over and over again. And I'm not saying that's a negative, but then you have on the flip side of the mom and pop just trying to make it to next week. So where is that balance? I don't know. And it all leads back to politics. We have people in office that have been there for decades that really haven't done anything fruitful for their constituents, which I don't agree with. So sometimes you need change. But with change comes what we're having, divideness and all these types of things, right? So I'll leave it at that. That's why there is this, divideness within, the political parties. I'm a registered independent. I vote for what's right. I don't vote for if someone is right or left. I don't even understand what's right or left, quite frankly. But I vote for what's right and what's going to be the best for not only for my family, but for the greater good, because at the end of the day, as you see with the pictures from NASA of the astronauts, right, flying to the moon, and they're taking pictures of Earth, that's all of us right there in that picture, right, in this one little ball, right? And we have to try to work it out somehow. And I think that kind of gets lost in people's thinking because, again, it's always like, it's me. And, sometimes I don't agree with that.
My next word is tax.
I would say what comes to mind with tax specifically is how can we be efficient with it? You can't avoid it, right? But you can be efficient with it. The IRS, very few people I know, actually one of the tax strategy partners that I work with knows a lot of the tax codes. There's a lot of tax codes in there that are for the betterment of people filing taxes. It's just a lot of people don't know that. So having a good CPA, having a good tax strategist in your corner will be very influential for your overall taxes.
Wealth.
I think you gave me that word one time before. I look at wealth differently than others. Wealth to me is opportunity, and it will always be. As you get older, you realize having money is nice, but with money, creating experiences and memories is what is the end goal, right? I've said this many times before. It was a quote I heard from Denzel Washington. You don't see a U-Haul behind a hearse, so you can't take your materialistic things with you. So when you have wealth, you can do many things with it, and that's obviously on you. You could buy things that you like. You can go on experiences, travel. You can do good for others. And I don't judge anyone for what they want to use their wealth for. For me specifically, learning this from my family, it's always about experiences and trying to do good for others.
Cash flow.
Oh, man.
My favorite.
What comes to mind with cash flow is flexibility, being able to sleep at night. I don't know if there's a synonym for that, but I could think of being able to sleep at night. I think it gives people a lot of flexibility on what they can do, not just personally, but as well as professionally, with their time. I think that's what cash flow does. It gives you a lot of flexibility with your time.
Shuvam, I want to thank you so much for your time today. Again, I'm looking forward to continuing this series and the guests that we're going to be bringing on. I think, for this episode, just giving people that little bit of encouragement, right? To listen to this and to say, you know what, we don't know what the future is going to hold. We know that for sure. We stay in the unknown, but to be able to know, okay, how can we move? I think with the big key word was strategy, right? How can we move with strategy? How can we work with someone? How can we move in alignment that still is going to get us to where we're trying to go? Because you can't predict what's going to happen. No one could predict what happened with this thing. And what you said, one person looked through their bottom line over 250, just with gas prices. That's insane. We call for these things. So to be able to have someone on the side to be able to help you go through it. And I think this was quite a powerful episode.
Yeah, I mean, the last thing I'll always say is in situations like this, I mean, it's probably an adage to life is you could control the controllables, right? That's all we can do. You can't overreact to things. You could only control how you react to things. So, as you're speaking with families, Ujira, and if anyone listening, if they just want a review of what they're doing, I mean, we're happy to do that complimentary. I don't charge for those types of things, and our team will be happy to review anything that anyone is doing.
Perfect. Okay. Thank you so much, Shuvam. And we'll see you on the next episode of our Family Office series. More conversations around the pain points that families go through when it comes to wealth, when it comes to, building for their next generations and beyond. And we're going to keep giving you such vital and powerful information. So thank you, guys.
Awesome. Thank you.
Thanks, Shuvam. Bye.
Hey, what's wrong? Bro, I'm stressed out. I'm running my business. I've got to serve my customers, but I need more customers coming in. I can't keep relying on word of mouth. Why don't you just use ETS Rabasha Media? Who? Well, with AI now, what they do is they go in, get your perfect clients, bring them in front of you. So all I got to do is run my business and he brings me opportunities. Think about it.
You speak to 3,000 of your ideal customers, convert 1% of that 3,000. That's 30 people. 30 people in a room with you. Can you convert that? Of course I'll close them. I'm good at what I do. I just don't have time to be going and looking for my perfect client. Focus on what you love doing and let them bring you customers. When you win, they win, commission, cha-ching. Sujira Rubasha, huh? Yeah, Sujira Rubasha. Go and Google them, man. Come on, take it to the bank.
If you really enjoyed this video, make sure to click here, and I'm sure you're gonna love that one.